Hello, everybody. I am Juanita Carr from JIT Tax, and we are going live tonight with our week 2 of our series of Don't Blow It, How to Spend Your Tax Refunds. So I'm hoping that everyone can join us. We're just going to wait a little while and wait for some folks to come in the live and then we'll get started. I am excited because this week we are doing basically week 2 of our series. And this week we're going to be talking about assets. So, what are assets and what are liabilities, net worth? Sometimes I get a lot of questions on that. So, and it's like a intricate, part of being able to take the tax refunds, like an asset, like a tax refund, and flip it. So, in order for us to want to gain value out of flipping our refunds, then we got to kind of know about what assets are and how are they important to our financial literacy, how are they important to wanting to build financial wealth. So I think it's very important that everybody get this information tonight. And we had some questions come in, so I'm excited about answering those questions as well. So everyone can get their questions answered, and we can continue to provide financial literacy within the JIT community. So first of all, let's recap last week. So last week, our first session was basically on money mindset. So money mindset, we pretty much just talked about how um, our the way that we view money affects our spending, affects our ideas about money, affects us being able to understand how much we should make to live comfortable. And one of the questions that we got last week was, well, what does it mean to be comfortable, and do you need to create extra streams of income? Do you have to make X amount of money or dollars to be comfortable? So I did want to address that question because I thought that was a great question. And in terms of being comfortable and financial literacy, technically they're two different things, but you would have to understand financial literacy in a way that would make you understand what amount or what type of finances do you need to have in order to be comfortable. So first, being comfortable is really a personal choice and what your financial goals are. So some people's financial goals might be to own a home, might be generational wealth, might be to retire early, might be to retire comfortably, right? Because some people do retire, they work their butts off 20, 25, 30 years, and then in retirement they're not even comfortable with the finances they have. So when we talk about comfort and what is comfortable, you got to make sure that you are setting your bar to where that is for you. And one of the things you want to do is just write down your goals, write down what your financial goals are and how they align with your purpose and the things that you want in life. And what does it look like for you to be comfortable? And sometimes we have to be realistic about that. And that's what we talked about mindset, right? Because a lot of times what our comfort goals are and what our view of money is and what that actually might look like in terms of how much you need to make or what assets you have is not in line sometimes with what our thinking is or what we think that number should be. So you got to be realistic with yourself and write down those items. And then how much does it cost? So how much would it cost to meet those goals? How much would it cost for you to be 100% comfortable financially? And that would be now and then also in the future, right? Okay. So, what is it about assets? Why are assets important to meeting the financial goals? Well, especially if you're a business owner and you are on here and you're listening to this tonight, then it's very important that you understand what assets are, what liabilities are, and what net worth is, because that is really the backbone of your business, and it's really the backbone of understanding the numbers for your business. But in terms of if you don't have a business, and even if you want to embark on this journey of using your tax refund to create an asset, then the first thing you need to do is find out what an asset is. So let's get into that. What's an asset? So an asset is really anything, it could be tangible or intangible, that has value. So any type of item, it could be cash, so money, cash money. It could be real estate. It could be investments. It can be a vehicle. So we could talk about that if the vehicle has value. So there are some assets that are traditional assets that you might have heard of, and some that you might not have heard of. There's new assets that are on the market now. If you heard of like NFTs, and different digital assets. So now we're in the world of digital assets. There's digital real estate. If you haven't ever heard of that. Art can be an asset because it holds value. So I think sometimes when people think about assets, they don't think about things like art, or and that could be in the form of paintings. It could be in the form of physical art, things like that. Digital art are also assets. And just in general, anything that has value. You can have things in your house that you had for a long, long time, and those are assets as well. So one of the things that when I do in my budget class and we want to figure out people's net value is I tell everyone to go around and kind of take an inventory of what's in your house. And you would be so surprised how many things that you actually own that hold value, that are assets already. So a lot of people think like, oh, I don't own a home, so I don't have assets. And that is not true. So even if you have cash in the bank, if you have items, some people collect things, sneakers, high-end sneakers, different things like that. And those are still considered assets. So it doesn't mean that you don't have an asset. If it holds a value, if it's something that today, if you ever heard of fair market value, what a fair market value is, if you were to sell it today, in the market that it's in, what would be the fair price that you would receive? So that's what fair market value is. So if you have an asset and it has a fair market value, then if you have an item that has a fair market value, then you therefore have assets. So cash is also an asset. So if you have a bank account and you have cash, that's an asset. So go around, just do an inventory. I would even say write it down and do an inventory of all the assets that you can find in your house, and write down the fair market value, which is if I sold this today, how much could I get for it, right? And you'll see some of those items are worth more, and some of them might be, worth less. So just do an inventory of that. And then I want, when we get in a Facebook group and we have our question and answer Q&A, people can bring that number, how much, when you tallied up everything, how much were all your assets worth. So the next thing is liability. So now that we know what assets are, what are liabilities? Well, liabilities are literally the opposite of assets. These are things that technically take away from something's value. So anything that is a liability is something that is a debt or owed or takes away from a value. So for instance, if you have you owe credit card debt, or you have debt from a credit card, debt from loans, debt from mortgages, those are liabilities, because those are things that would take away from the value of an asset because it's owed on that asset. So let me give you an example. If you did own a baseball card, I'm just going to give you a quick example. And the baseball card was worth $100. However, the baseball card was equally owned by your brother. So you and your brother had a baseball card, and the full value of the baseball card is $100, but you owe him half. So half of that $100, which is the $50, belongs to your brother. So even though the baseball card is an asset, the debt to your brother is a liability. So your we'll get to net worth, but your net worth on that card would be $50, not $100, because you have a liability that's going to occur with receiving that fair market value. So that's really what liabilities are. It works the same in terms of a mortgage. If you own a home, the home itself is your asset. So the fair market value of that home at the time is your asset. And if you want to talk about equity, some people don't really know what equity is in a home. And what that is that when you first purchase the home and you buy it for a certain price, that price is how much you bought it for. But then it could be a certain amount of time. Again, the fair market value of the house. So if the housing market goes up, then the fair market value of that house could be different than when you first bought it. Also, what you have paid on it, meaning whatever that balance is in the liability. So the loan, the mortgage, is a liability, and you have to obviously take that from the asset. And net worth, which is the amount you owe versus the fair market value of what it's worth, then actually becomes equity. So equity in your house is pretty much just like the definition of net worth. It is how much money or liquidity is what we also call it, that you have in your asset after any liabilities are paid. Okay. So why is it so important for us to know about net worth? Why is it so important to know about assets and liabilities? Well, one of the main things is that you need to know pretty much, what you have in order to create financial independence, right? If you want to create additional streams of income, if you want to have an idea of what comfort looks like for you financially, and you have that number, how do you get to that number? A lot of people don't understand, even when they get paid at work, money comes in, and that your paycheck is an asset. Your paycheck is an amount of cash that has value, and it's what you do with the paycheck. So if you have, a bill that's $100, and you take $100 and you pay that bill, then that cash asset that you just had from your paycheck just got basically eaten up by the liability, which is the bill you just paid. So then what do you have left? Nothing. So why that's important is because if you want to take assets or accrue assets, then you want to make sure that they are things that will not equal out or balance off with liabilities. You want to create assets that actually have value, keep their value, or continuously provide things like cash flow and equity. So it's very important that you choose the type of asset that you want to create when you think about financial independence, financial literacy, what your goals are in creating cash flow for yourself and your family. Those are the things you want to think about. Is, does this asset actually bring me closer to my goal of what I'm looking for to live comfortably financially? So let's just get into that. What are some things that people can think about when building assets, and what does that have to do with my tax refund, right? Like, we're all here to talk about not blowing your tax refund. So the thing is that part of the next couple of weeks, we want everyone to kind of think of what asset can be created by the tax refund. The tax refund itself is actually an asset. So if you have a tax refund of $2,500, then you have actually value, right? Your taxes have value, that cash value. It could be sitting at the IRS waiting to get released. It still has value. It could be sitting in your bank account. It still has value. Until you spend it is whether the value holds. So if you spend the money on an asset, then you could take one asset and convert it into another asset. And that asset can either hold the same value, hold less value, or even hold more value. So you could take your $2,500 tax refund, and at that time, if it goes into your bank account, then we would call it cash. We're still calling bank accounts, cash. So even though it's kind of in the digital world now, we still would consider that to be cash. So it has a cash value or a fair market value of exactly what it is at that time. So the 2,500 would still be 2,500. But you could take that same 2,500 and you could put it into another asset. And again, depending on the asset it could either hold that same $2,500 value, it could increase in value, or it could decrease in value because of liabilities. And let me give you an example of that. So let's say you take 2,500 of your tax refund and you want to buy a car, and you're saying, I need a car. I just want to get me a little hoop ride to get me from A to B. And I need this car in order to produce more income. Maybe you really need your car to get to work, things like that. And you need to do that. Well, I just want you to understand what happens when you purchase a vehicle. Doesn't mean you don't purchase a vehicle, but 9 times out of 10 with most vehicles, once you transfer the cash into owning the vehicle, which in itself could be an asset, what happens is the fair market value now of that car is normally less than what you paid for it. So because assets can depreciate, or the fair market value just goes down. So if you buy, say, a $2,500 car, I'm just using that as an example, and you pay the $2,500, normally the seller is wanting to basically make a profit. So they're normally going to sell it to you at either the fair market value or higher, depending on what they think it's worth. When you receive the asset, the exchange of the asset, now that asset to you is not worth $2,500. It's actually worth whatever the fair market value is at that time. And a month later, 2 months later, cars tend to depreciate right away. So for instance, the longer you have the car, the less it holds its value. So if you probably had a car for 6 months to a year, then it would automatically the fair market value would automatically drop, because values of cars, unless it's like an antique or certain types of cars, the value is the value of it is also in the amount of time that it's been on the road, how many miles, all of these things. If you guys ever bought a car, sold a car, then you kind of know what I'm talking about. So just understand that when you transfer assets, when you pay for things like cars, the amount that you had to pay for that car is a liability, even though you end up with an asset, but you could end up with less. So what we want to do is, when you have an asset like cash or a tax refund, or any money that you even earn day to day, when you transfer that over, when you give it away, you want to obtain another asset for it that holds cash value, holds its fair market value, or gives you more, because that then would allow you to retain, kind of what it's worth, and be able to use it for other things. And that's pretty much what we want to talk about, across these next couple of weeks, is how do we do that with our tax refunds. And then what we'll even get down to is how that asset can create more cash flow in order to continue to add value. If you give your money, let me give you an example of that. If you give your money away to a bill collector, right? So you have 20. So the number one thing that people spend their tax refunds on is bills. So we did a poll with our customers and our clients and the public, and we said, what are you spending your tax refund on? 90% of clients who receive tax refunds are spending their tax refunds on paying down bills. And I'm not saying that that's a bad thing, but once you transfer, again, it's the same thing. If you have $2,500 and you paid $2,500 worth of bills, That's it. Your money is gone. You have then depleted any asset you have. You no longer have an asset. You have taken that money and gave it away, and you actually have given your asset to the bill collector. So whoever owns the bill, Instar, Keyspin, whoever is owning of the bill, they now have asset in their company because you handed it over to them. Why would we do that? Like, why would we want to take our assets and hand them over to other people? Why not take an asset that creates another asset that can then create more value and cash flow to then pay that bill, so that you maintain your asset and your fair market value, and something else that is being earned from that asset then goes to paying your bills. That's what they're doing. If they're a company, if they're personal, most of the time that's how they're handling their assets. That is a better financial practice of handling assets. So not just handing it over and giving it away so that now you lose all your value, but to create or transfer the value to something that can actually add more value. So I'll give you an example of that. The same $2,500 that we just talked about for purchasing the car or paying a bill. So let's take our $2,500 and let's not buy a car. Let's not pay a bill. How about we create a small business with the 2,500? How about let me choose, what kind of business should I choose? Let's choose a hair business, braiders. There's a lot of hair business going on, braids, extensions, things like that. So what if you could just even buy inventory? So what if you went out and you took the $2,500 and you purchased hair? You purchased hair and you bought it in a bulk. So therefore, now the amount you paid, the 2,500, you could probably potentially get a certain amount for that 2,500. But if you sold it, so what if that bulk was worth, you paid 2,500, but it was worth 5,000? So if it was worth 5,000 and you sold it for 5,000, then now you just actually increased your net worth. So you took an asset and you increased that asset, and then also increased your net worth to have double what that asset was when it originally started. Now you could take the $2,500 that was left and buy the car or pay your bill. Guess what? You still have the extra 2,500 as an asset to do whatever you want. So you can either transfer that into more business activities, or you could do tons of other things with that asset. And guess what? It's the same asset. So it's the same $2,500. And this is why we're calling this Flip My Refund, because you can literally take that, transfer it into an asset that doubles itself, and then use the profit, is what we call it, from being able to flip your refund in order to now do some of these other things you need to do, pay bills, buy a car, without affecting the value of the original asset. Okay. So we're hoping that everybody understands that. One of the things I want you to do this week after this week's webinar, this week's live, is to remember, I said, go home, look at the assets you have lying around. What are they? How much, do you feel like you already have in assets, bank accounts? If you do own a home, how much equity do you have? You want to add all of these things up, and then that is really your value. So that is your net wealth. So basically, it actually tells you how much you are worth. What your net assets are, your value, you as a person. How much? It doesn't mean, let me not say that, because it's obviously intangible values that are priceless, so we're not putting a value on it. So when we talk about assets and values, we're actually talking about in the financial sense. Okay. And you can figure out how much you are worth. So you need to also know your liabilities. So you need to also know how much you are spending or need to spend every month. If you've already crossed the month and you owe a bill, then that takes from your assets. If you own a home and you have mortgages or loans, that takes from it, credit cards, things like that. So you do have to kind of do the math a little bit. There's plenty of apps out there. So if you ever need an app that can help you with this, figuring out your net worth or your net value, then there's plenty of apps. So you can upload all of your there's Credit Karma. Mint used to be a good one, but they just switched to Credit Karma. There's Empowerment. Chase, if you have a Chase bank account or credit card, then they have an app where you can import all of your assets. Insurance is an asset, so I know some people kind of will go up and down on that, but insurance is considered an asset because even if it's within a term, at the time of the term, it does hold some type of value at the time until it expires. So like I said before, things can expire and the value of that item can expire. So you want to go and you want to maybe download one of these apps to help you out, or if you're old school, you could just write it down. So take an inventory of everything you own, anything that has met value. Take an inventory of everything that you owe or its liability. And listen, if you owe your brother $50, you need to put down that $50. Like, oh, I owe him, even if it was from back in the day, because you really want to be able to see, what is it that I have in my net worth. And once you figure that out, then now you can think about what you have left to do what I'm talking about, which is transfer those assets into other opportunities to flip them, to create cash flow that can leave you with the value you have, but create cash flow to pay off some debts and things like that. And I'm just saying, I've seen it before, I've done it myself. This is the best way to continue to add assets and to continue to grow your net worth, and also not to allow your bills to become more liabilities than assets. Okay, so if you follow along with this, if you're doing your homework for the week, then I think that by the time we're done, I know by the time we're done in the 6 weeks, you'll have an asset that's going to be creating cash flow. Okay, so let's do this. Let's stop here, go into the Facebook group, Flip My Refund, add any questions from this live tonight that you want answered on the next live, or just give some feedback around, what type of assets you realize you had just looking around the house, and what your net worth is. What number did you come up? Did it surprise you? Do you have a lot of work to do, to work on limiting your liabilities from being much higher than your assets? And also, let's start talking about how much you have in your tax refund and what type of things that you can start doing, because we'll be talking about that next week. So next week, we're going to start getting into like some ideas of what you can do to flip the money and what that actually looks like. I'm hoping to bring a little board. We can kind of figure out what that actually looks like in numbers. So let's do that next week. Let's bring some ideas on things we'll be doing. We'll be focusing on 3 items. So one is investments. The other one is real estate, which is technically an investment, but the first one is going to be like stock, bonds, investment, things that you can invest in that can then flip value. The second one is going to be real estate. And then the third one is going to be businesses. And we're talking about those 3 because those are the ones that I have seen for myself, for my clients, that tend to be most effective in being able to take something like a tax refund and flip it so that it continuously keeps its fair market value and then adds additional value to pay off liabilities. All right. So don't forget, go on the Facebook, go into the Facebook group, post your questions, post what your assets are, your liabilities, and your net worth, or ask questions if you have more questions around what some of the definitions and stuff we learned tonight. Okay, all right. I am excited. Next week, again, we'll be talking about what types of activities you can do to invest your tax refund in order for it to hold its value. Remember, we're creating assets that hold value. All right, y'all have a great evening, and we'll talk soon.